In the components of cost of capital, we have seen the one component, that is cost of equity, and we also uh, saw how to calculate the cost of equity. Now let's move to the other component in the calculation of cost of capital, that is cost of debt. What is cost of debt? It is a return that a company provides to its debt holders and creditors. These capital providers need to be compensated for any risk exposure that comes with lending to a company. Since observable interest rates play a big role in quantifying the cost of debt, it is relatively more straightforward to calculate the cost of debt than the cost of equity. Not only does the cost of debt reflects the default risk of a company, but it also reflects the level of interest rate in the market. In addition, it's an integral part of calculating companies' weighted average cost of capital, or WACC. Estimating the cost of debt, YTM. There are two common ways of estimating the cost of debt. The first approach is to look at the current yield to maturity, or YTM, of company's debt. If the company is public limited company, then it could have a observable debt in the market. An example would be a straight bond that makes regular interest payment and pay back the principal at maturity. This approach is widely used when the company being analyzed as a simple capital structure where it doesn't have multiple tranches of debt, including a subordinated debt or senior debt, for example, with each having a significantly different interest rate. Calculation of cost of debt of a bond. Present value of a par value plus PV of a coupon payment. PV is equal to coupon divided by 1 plus YTM raised to the power 1, and goes on like that, where the PV is the price of a bond, PV is the par value, FE is the par value. Solving for YTM. So the answer is the cost of debt is the YTM. Then matrix pricing debt ratings. The second approach is to look at the credit rating of the firm found from credit rating agencies such as S&P, Moody's, and Fitch. A yield spread over US treasuries can be determined based on that given rating. That yield spread can then be added to the risk-free rate to find the cost of debt of the company. This approach is particularly useful for private companies that don't have a directly observable cost of debt in the market. Simply put, a company with no current market data will have to look at its current or implied credit rating and comparable debts to estimate its cost of debt. When comparing, the capital structure of a company should be in line with its peers. When neither the YTM nor the debt rating approach works, the analyst can estimate a rating for the company. This happens in situations where the company doesn't have a bond or credit rating, where it has multiple ratings. We would look at the leverage ratios of the company, in particular its interest coverage ratio. A higher number for this ratio means the safer borrower. The yield spread can then be estimated from that rating. Always the debt as a relatively cheaper form of finance, but at some point of time, when obtaining external financing, the issuance of debt is usually considered to be a cheaper source of financing than the issuance of equity. One reason is that debt, such as a corporate bond, has fixed interest payment. In equity financing, however, there are claims on earnings. The larger the ownership stake of a shareholders in the business, the greater he or she participates in the potential upside of those earnings. Another reason is the tax benefit of interest expense. The income tax paid by a business will be lower because the interest component of debt will be deducted from the taxable income, whereas the dividend received by equity holders are not tax deductible. The marginal tax rate is used when calculating after tax rate. The true cost of debt is expressed by formula after tax minus cost of debt is equal to cost of debt into 1 minus tax rate. Thank you.